you for everybody for joining. Um, and there will be more people arriving as we can see. It's so exciting to be able to have this conversation with everybody because often what we do is we get told that we've got to go out and sell, we've got to go out and market, we get our blueprint together. There's so many amazing things that we do within our business, but what do we do with the money that we earn? Where do we put it? And should we be putting it somewhere? In the olden days, they used to say that there was underneath the mattress. You need to store your money under the mattress. And then the banks went into all sorts of decline. And then it was back to the old way, storing money in the mattress or in your safe or in wherever. But I always was taught that you had to have seven streams of income, and that includes things like interest or something that's happening with the money. Because the moment your money hits the bank account, it should be doing something for you. And I think that that becomes really important for each of us as we grow in our business. What are you doing with your money? So we want your money to be more and more and your wealth to start accumulating so that one day you can have the lifestyle that you're looking for, or maybe you're having it now, who knows? But it's really exciting to share today with Pierre. The other evening, I was invited to Citadel where we heard about the trends that were happening around the world with regards to the economy. And I thought that that was a really nice talk for everybody that's here since we've got people from across the globe. And what is happening in the economy, what's happening with our money, what should we be doing with our money, and what are the trends that are happening? So thank you so much, Pierre, for agreeing to be here today. It's really exciting to have you. So over to you. Everybody, please ask questions. Pierre's got a wealth of information, and so has Rebecca that have joined on here as well today. So if there's any questions, please ask as we go along, but we will take questions at the end as well.
Thank you for that introduction. And hello, everyone. It's wonderful to be here with you today. Just want to share my screen quickly and then we can jump in.
Hear him properly?
Can you guys hear me? All good? Shall we start? All right. All right, so just the agenda that we want to touch on, and as Diane said, please stop me. Let's make this interactive. Definitely don't want this just to be sort of one-sided. But some of the thoughts that I was thinking about sharing. Firstly, just the idea of wealth generation, the enjoyment thereof, the growth of our wealth, and then legacy. Secondly, AI opportunities and challenges. I think we've all heard so much about AI. But I think it does play quite a big role in terms of future wealth generation and also the growth, investment growth going forward. Going to touch on the global economy and trends, fast-growing industries, investment portfolio construction. How do you construct a portfolio between conservative and longer-term growth? Touch on estate planning structures, and we will definitely have some time for Q&A or an interactive discussion. Karen, I see your hand went up.
Sorry, Pierre, you're very, very quiet.
Okay, let me see if I can adjust my... Is it quiet for everyone?
Yes.
Still a little bit quiet, yeah.
I've turned up my volume just very loud so I can hear you.
Let me just see if I can adjust my audio. Microphone. Input volume. Let's leave that up. It's getting better.
Better. Thank you.
There we go. There we go. Thanks for flagging that. I just want to share again. Okay, so better now. All good.
Yes.
All right.
Good. Thank you.
Thanks for flagging that. All right, and then just the normal disclaimer, guys. I think suitable financial advice must always be in line with your holistic financial position. So we're going to share some ideas. Please don't take anything as a standalone, for your personal situation, and please always just make sure it makes sense in your holistic financial plan. All right, just quickly who we are. Citadel Wealth Management. Our primary focus is global investments and estate planning. We're a South African-based company, and we have a global affiliation via Peregrine Wealth out in Guernsey. Been around for about 33 years. We manage amount north of 110 billion of assets under management. Just added our website there. There's also a Citadel Securities out in the US, but we are not affiliated with them at all. So there's our website if you wanted to have a look. All right, so let's jump in. I think the first thing is just this idea of wealth generation. How do we enjoy it? How do we grow our wealth? And how do we think about legacy? And I want to touch on these four economies that's typically that we're typically involved with. The first is our business and the wealth generation economy. And that's really where we generate our wealth. Second one is our personal economy. That's sort of the enjoyment and the consumption of the fruits of our labor. We've got the investments and growth economy. That's really where we play in. How do we invest the capital? How do we let it grow over time? And the fourth bucket is legacy. It's social impact. And if we're fortunate enough, if we can leave capital for the next generation. And I'll just touch on each of these areas. In terms of business and wealth generation, this is really where you guys are the experts and where Diane is the expert. It's typically, this is not our game. You know how to grow your business fastest. It's typically a high concentration area. So you typically concentrate your time, your energy, your resources, your capital. Leverage can sometimes be appropriate in this environment to enhance your growth. And return on investment, it varies significantly across businesses. But typically, you're looking at a higher return on capital and a higher return on investment, 30%, 40%, or numbers north of that. So for entrepreneurs, this is really the fastest way to create wealth. For salary earners, they would typically invest monthly into the financial markets, and we'll touch on that. But with the entrepreneurs that I work with, typically this is where you generate wealth the fastest. And the second one is our personal economy. This should naturally be a function of our business success and not the other way around. And yet, I guess it's really important for us to balance living today and building memories today and enjoying today with still building enough sources of income or investments for the long run. And this is typically where we try to help our clients with financial modeling to make sure there's enough for shorter term expenses, trips, important purchases for the family, while still having the peace of mind that there will be sufficient capital for the long run. In the third bucket, that's investments and growth. This is really where the area that we play in. The goal here is really to protect capital and to beat inflation with, let's call it 6% per year. If you look historically, the historic growth on the S&P 500, US equity index, it's about 10% per year in US dollar terms. Now, if we just jump over back again here, that's why I said, in a business environment, you will typically achieve a much higher return on investment or capital, 30% or north, where this environment is more an environment of protecting capital, beating inflation, and ensuring there's sufficient capital, for the long run. So typically a lower growth environment with a focus on protection, beating inflation, but not the fastest horse. Your business is typically the fastest horse, and that's why we typically see entrepreneurs often reinvesting surplus cash flow back into the business while they are growing, because that's really where they enjoy the highest return. And maybe later on, as they want to scale down, to start diversifying into this environment. In the business environment, we talk about concentration, leverage, narrow focus. But in this environment, we talk about diversification. Over here, we want to move away from being a business owner in one industry, in one country in the world, or owning one property in one address, in one place in the world, to having ownership in multiple assets. For example, being a shareholder in multiple companies around the world. And we can talk about how to achieve that and so on. But the focus here is diversification. You want to move away from the high risk, high focus environment you had while building up your wealth. And in this space, we don't want leverage. This is an environment where we want to protect capital for the long run, and leverage is too risky for this type of environment. And then the last bucket, that is where we can have a social impact. We can think about philanthropy, while we are here and while we are alive. And then, should we be fortunate enough to be able to leave surplus wealth at the end of our lifetimes, that's where it becomes especially important to think about estate planning and structures. And I will just touch on those. All right, as I mentioned, we hear so much about AI, but I do think it's so topical when we think about those previous buckets, those economies, how we generate our wealth going forward, and also how we grow it from an investment point of view. AI will have a massive impact on those. So at the moment, before AI, we're sitting with a declining global population. We're sitting with an aging population and a declining productivity. So if it wasn't for AI, you would have sort of seen over the years GDP dropping off around the world, and productivity dropping. And actually, with AI, there's just this explosion of productivity. And actually, it's so much quicker, easier, and cheaper to produce many things. And we're just seeing a explosion of production, which will really help the world going forward from a GDP and a growth point of view. We'll touch on the challenges, but that's just from a productivity and a growth point of view. We all know this. We'll touch on it. There's naturally many careers and many jobs that will be negatively impacted by AI replacing, their functions. But I guess for all of us, it becomes an opportunity to think, how can I pivot to work with agents and to work with AI to enhance my output, and not see it necessarily as a threat, but how can we work with it to enhance our output and enhance our productivity? Because it is really incredible what we can do these days in a short space of time, just based on some of these AI tools that we use. The cost of knowledge is declining fast. So again, it's a double-edged sword, for those who really sold knowledge in the past or where knowledge was extremely valuable. That is declining fast. Knowledge is becoming very accessible. But again, I want to focus on the positive here. I think it's incredible for the world to have access to that knowledge at our fingertips quickly. Anyone in the world can access it. And that is really powerful for the world going forward. AI is also deflationary, in a world where everyone is worried about inflation and prices going up and up and up. AI is deflationary, with this massive productivity, there's an increase of supply in many areas, many products, many services, and that brings down prices. It makes services and products more accessible for more people around the world, which is also a positive thing. Medical advancements, we're already seeing this. I reckon in the next 5 years, we're going to see amazing medical breakthroughs. People will live longer and longer. We've already been seeing this over the last couple of years, but especially with AI, we'll just see a massive uptick in this. It does bring a bit of a challenge on the other end as well. If we're going to live longer and longer, what are we going to do? Are we going to work a little bit longer? Do we need to build up more investments and cash flow streams to be able to support us longer? So those are important things to think about. And then some investment opportunities, specifically in this AI environment. There's a massive capital expenditure at this stage going into hardware. In the past, software companies was really sought after. They built this software, they sold it, at high prices. But software is now becoming very easy to develop quickly, much cheaper. So the capex is really going into hardware, computer chips, materials and natural resources. We've seen a massive uptick in the price of gold and silver and platinum and copper. So it's all these natural resources that you need for robots and drones and electronic vehicles and all these, type of advancements. And then lastly, diversification is one of those old, boring, sayings in the investment world. But again, it will just be so powerful going forward because the world is changing so fast. Today's winners may become disrupted, and it's very important to remain diversified between different equities, between different asset classes, and not just to pick one horse and to bet on one horse, and then that horse might be replaced overnight. All right, we know the disruptive impact of AI, routine workers, knowledge workers, and entry-level work. I mentioned software. I'm sure you guys have seen it, but just this vibe coding where you just talk to the AI and it writes the code for you in the background. Very powerful. It's not going to replace all developers overnight, but apps and very simple websites can now be built very quickly just by talking to AI, and it does the coding for you. You don't need a programmer in the background. Financial services, just over the last week or two, AI coming out that can do tax, more very complicated tax and accounting planning. So we saw the share prices of some of those large consultants that focuses in these areas dropping, significantly. Logistics, AI came out that can sort of 10x a logistic business's sales without hiring, one more person. We're going to see self-driving trucks on the road, very soon. So again, quite disruptive, in those industries. And then humanoid robots, at the moment they're still a little bit clumsy, but it's amazing how they're working on the dexterity, of their hands. We're seeing them in manufacturing. They'll be able to do domestic tasks. So quite disruptive in many areas. So I guess the question is what will be valuable and resilient assets going forward? And I would actually love to hear from the group as well, where it is now at the end. This is just my little take on it. But what would be valuable, in a world where AI replaces so many skill sets? I think trust. I think we can talk with ChatGPT and it can say it understands you and it hears you, but I think we place trust in human beings in a much different manner. I think being human, empathy, real care for one another. As I say, it's amazing how these large language models can communicate emotions, but we know they can't feel it. It's code, it's computers, and only a human can really understand and really feel with us and for us. Networks, I think networks like this that you are a part of is extremely valuable. I can't replace that. And then financial assets, building up financial assets, whether it's multiple sources of income, as Diane mentioned, or whether it's financial assets, shares, equities, property, maybe hard assets. Those are the things AI won't be able to replace. Right, let's touch on just what's sort of happening, very quickly around the globe. This first one is just really a summary of 2025, because it's just such an important theme that's still running through into 2026. The first one, as I mentioned, just a massive investment into CapEx in this whole AI investment cycle. The S&P 500 did extremely well last year. You can see at bottom right, 16% in dollar terms. That's almost double what you get, over the last long run. Especially the technology sector, as we mentioned, the whole AI theme did really well. Maybe just on the S&P 500, I mean, a lot of people are asking, is this a tech bubble, like the 2000s? We don't think so. We think in the 2000s, there was a lot of investments into this internet thing, but it wasn't supported by earnings yet. Well, a lot of the companies that's done well, the earnings are supporting the prices. So ironically, we've actually seen the PE ratios of the tech sector coming down somewhat as the earnings are being reported, because the prices are really supported by earnings. The companies are making a lot of money. It's not just a pipe dream and hopes. They are really doing very well. They're selling a lot of product in this space. Donald Trump, a lot can be said about him, but one thing is that he is definitely business friendly and market friendly. He will do anything in his power to keep the markets running, especially with the midterms also coming up. Resilient economic growth all around the world. There's fairly resilient economic growth and ticking along, so that was quite healthy. We'll touch on it, but all around the globe, Federal Reserve banks are reducing interest rates. So we're in a reducing interest rate cycle, which help markets, it helps business owners with debt. It just oils the whole machine and supports markets going further. Deal activity surge, global trade is very healthy. And then the big talk was the gold price. Gold was up. It was asleep for many decades, and then suddenly it woke up and it ran 44% last year. And the question is really why, and will it continue? The big reason is really it's not individuals buying jewelry. It is large reserve banks, especially in the East, who's really beefing up their reserves with gold. And the reason is really that they are slowly losing trust in the US dollar, and traditional US safe haven assets like US bonds. So there's definitely a very slow movement away from that. How long will it last? Difficult to say. But I just want to show you historical cycles. I mean, after something has run so hard, it's usually expected that it's the end of the story. You should sort of go into a bear phase again. But the thing with resources and with gold, these are historic cycles. So the blue one you'll see here, that was 1971 till 1980. That was about a 9-year period. You'll see this purple one was 1999 to 2011, so about a 12-year run. And the current run has only been going on for 8 years. So again, we'll have to see where that goes. I think the point is just when gold and resources go on a commodity run, they often can carry on, much further than one can expect, especially because it's not retail driven. It's really a structural change where reserve banks really want to beef up their reserves. And if you actually have a look at China's percentage reserve in gold, it's actually still fairly low compared to the past. So it might still have some legs to run. All right, so there's a lot of optimism and excitement, I think, going forward. The whole AI theme, productivity, investment opportunities. I think at the same time, it's just there's also merit in being slightly cautious. There's been various writings over the years. I'm not going to go through all of them. You can see them here on the screen. And what they really write about is long-term cycles, long-term debt cycles, demographic cycles, and technological change. And we are currently, next few years, we are sort of at a point where these long-term cycles are coming together. Historically, when that happened, it was similar to the 1929-1945 period, which was naturally, quite a tough period for various reasons. And not to say it's going to be repeated, but these are some of the themes that come sometime into play, when these long-term cycles collide. Some crises, inequality, debt spirals, nationalism, populism, individualism, creative destruction, conflict, war, institutional collapse. So again, I don't want to be depressing. I just want to paint the picture that while it's very exciting going forward, at the same time, we have these factors at play. So this guy here on the right, he dressed for the beach and he arrived at the North Pole. So I guess the message is just it's important to dress according to the climate out there and where you are heading. So perhaps the message is let's wear our shorts to the beach, but maybe pack in an extra warm jacket, in case there's some turbulence. And I guess coming back to investments, very important to invest for growth, invest with exciting opportunities, but always make sure there's buffers in the portfolio when there's volatility, because volatility will come. And for us, it's not a question of if, it's when. And your portfolio needs to be buffered against that. All right, just some quick graphs is economic growth around the world. The message here is just that global GDP and economic growth is ticking up. You see the US a little bit more than some of the others. It's dipping a little bit, but the general message is global GDP is positive and is ticking up in the right direction, and that is supporting growth. Sadly, and we all know this, it is not the same for everyone. We're looking at the US consumer because they have quite a big spending power globally. The message here is, so this is consumer confidence index. So this is how confident people are feeling about the world and about their situation. And you can see the highest earners, they feel most excited and most optimistic about the world, and the lowest earners, much less so. And the same with investments. Those who own stock and investments, I mean, I've just shown you how well the markets have been doing. Naturally, they're feeling good about the world. And those without any financial investments and stocks are naturally feeling, much, much worse about the world at this stage. So it's really, you might have heard about it, it's really this K-shaped economy that they talk about. So I'll see in the top 10% of, sorry, is it noisy in my background? Okay, it's just a leaf blower outside, so then we can continue. All right, so you'll see top 10% of the US earners account for nearly half of all consumer spending. So it's again the same story. The top 10% of US earners are feeling happy and doing well, while the bottom 8% not so. So it's really this K-shaped economy, and the big difference between the haves and the have-nots that we've heard of, so much. Unemployment slowly creeping up around the world. I guess the same story, for the lower income earners. And then just same story that AI is really a blessing and a curse in this environment, and it really widens this K It touches on some of the points we just mentioned, that productivity is up. So for individuals or companies, their productivity is going through the roof. Their profits are going up because they're saving quite significantly on staff. Where they're now being replaced by AI and processes. Inflation is coming down, so that's great. But for the lower earners, their wages are down, and you can see the job loss, sort of in that area of the market. So again, it widens that this vacation economy and it shows that this is just what the US GDP growth is made up of. You see the blue is AI investment. So again, same story. You can see a large uptick in AI investment. The red is the upper income consumer. So again, they're really supporting the economy, and green is the rest. So I guess the same story is that the US is really being driven by AI spend, the upper income consumer, and that's really driving the economy at this stage. Europe also doing a little bit better. Growth is slowly returning. The whole fiscal boost with defense spending being pumped into the economy. So these orange bars sticking up is their GDP, and you can also see the sentiment index picking up from the lows in COVID. So Europe also doing a little bit better. The EU consumer, you can see their assets to debt ratio is increasing. So the amount of assets they hold compared to debt is increasing, as well as their sentiment. So good on that front. And you'll see the unemployment slowly dropping off in the different areas of the Eurozone as well. So Europe doing fairly well. Global trade remains strong. You can see there was a big dip again in COVID, but recovered nicely. But the one important theme is the change. So on the left, you'll see this is the 2000s. The countries in blue, for them, the US was their largest trading partner in the 2000s. And in red, for them, China was their larger trading partner. And just look at the massive difference from 2000 to 2024. I mean, it's virtually the whole world has moved to a place where China is now their major trading partner and not the US. So we're definitely seeing a movement there, a strong, very strong movement, from the east to the west. West to east, other way around. Yeah, you can also see the same thing. I mean, Donald Trump came out with his tariffs and his trade wars, and China simply moved their trade elsewhere. So you can see this blue line is China's trade with the US dropping off significantly. And China simply went and they substituted that with the rest of the world. So still trading very, very strongly, and they just simply found other partners. So the whole tariff trade war thing, one can say, but backfired a little bit on that strategy. So China continuing to be very strong. Also, long-term trends that's interesting. You can see this global power shift. The orange is the advanced economies, sort of your first world economies, and the black is your emerging economies. And you can see, I mean, this over a long period. These are the years at the bottom, and you can just see how these lines are moving closer to one another. So the emerging economies are growing stronger. You've heard of the BRICS countries. And you're just seeing the developed countries, just dropping off in terms of their global power. And I guess back to the point we made earlier, when some of these long-term trends start to cross over, it does cause, some friction in the markets and especially geopolitics. Okay, globally, inflation is coming down, so that's great news. You can see different ways of measuring inflation. The message is just globally, inflation is under control and it's coming down. And what does that mean? It means interest rates can come down. Different areas of the world. And as I mentioned, lower interest rates just means it's an easier business environment for individuals, for businesses. They can borrow money, they can build their businesses. So it's really just the oil in the economy. So that's very supportive of growth going forward. Global manufacturing also ticking up. You see it's been plodding along a little bit. But whenever it's above that 50 line, it means there's advancement and there's some opportunity to push higher from there. So global manufacturing also looking healthy. The dollar is also an interesting one. It's fairly weak at this stage. So you can see it's sort of where we're sitting there. So the question is, will the dollar just continue to weaken from here on forward and lose its sort of global power? What you can see here, though, is currencies are cyclical. So this is sort of the long-term upward channel. And you can see, there's been a few periods where it's touched this lower part of the channel. So, I mean, there's a decent chance that it can sort of turn around and strengthen again going forward. But the theme we are watching closely is absolutely over the long run, the dollar and the US is slowly losing its historic strength that is held. It's not going to happen tomorrow. It's not going to happen next year. But there is very definitely a slow trend undergoing. At this stage, there's really no other currency that's liquid enough and large enough to replace the dollar. So that's why I say it's not happening next year. It's not happening the year thereafter. But it is a slow moving ship, and it's definitely a directional change, for the long term. All right, fast growing industries to watch out for, and which will also present investment opportunities going forward. We've touched on some of these already: artificial intelligence, robotics, cryptocurrency, and blockchain. There's a more and more regulation coming out around cryptocurrencies and blockchains. It looks like there will be quite a large tokenization of financial assets, which means stocks and fractional shares in properties, and many things can be placed on a blockchain and traded 24/7. So that is definitely coming. We're even seeing AI agents that's starting to do business with one another, and they use cryptocurrency to deal in that. So that's going to be interesting. Cybersecurity, as we're all chatting with Alexa and ChatGPT, and they know all our inmost secrets, cybersecurity is becoming more and more prevalent. I'm sure you've seen. The hackers obviously also use AI. So if they have a photo or they have a voice recording, they can impersonate a CEO who's giving instructions to his employees to transfer money to suppliers to make payments. So cybersecurity is becoming, even more important in this environment. Energy, the world will need a lot of energy to power all of this AI, and actually it needs to be renewable. So that's a very big theme going forward. Electric vehicles, different uptakes in different parts of the world. Some areas still more hybrid, but electric vehicles, self-driving vehicles, definitely the future. Health tech, as we mentioned, the technology and the AI is really assisting amazing medical breakthroughs and continuing to do so. We're seeing more of that. And then still e-commerce and digital retail. I think with people being online more and more, we're still seeing that sector sort of growing strong into the future. Okay. After everything that I mentioned, we talked about the markets, potential opportunities. I guess the question is then, how do you balance investments and a portfolio between conservative? You talked about, Diane, under the mattress, we want that safety. We want to sleep well. But at the same time, we know inflation is causing everything to become more expensive over time. We would like to still buy our favorite bottle of wine 10 years from now, even though the price have increased. And how do you balance conservative investments with faster growing investments? So this is our portfolio construction framework that's worked very well over the long run through difficult times as well as good. And it's really to say that the cash that you will need for the next 2 years from your portfolio, for whatever reason, ad hoc purchases, monthly supplements, let's say you start slowing down at some stage. But the cash that you will need from an investment portfolio for the next 2 years, it makes sense to invest that very conservatively, cash-like. There must be no volatility. We call that the stable bucket. And the reason for that is really that, as I mentioned, it's not will there be global uncertainty again. It's when will it come, and when that comes, whether it's a COVID as we experience, or whether it's a war or whatever it might be. The worst thing you can do in investments is when your shares, your good quality investments, are down because of temporary factors. The worst thing you can do is to sell them at that time to fund your monthly expenses or the needs that you might have. So this 2 years of cash flow really gives you that buffer that whatever happens around the world, you've got access to stable money to fund your needs. We really call this the sleep well bucket. This really enables you to sleep well. Doesn't matter what's going on because you've got 2 years of cash flow requirements ring-fenced. The subsequent sort of 2 to 4 years of cash flow needs, we would typically invest that in a low volatility type of environment. Call this the prudent bucket. The goal here is to earn a slightly higher income that you would earn just from cash, but still very, very low volatility. So no shares or equities here, things like hedge funds, bonds, so stable shock absorbers in your portfolio. We call this sort of the eat well bucket, where, as I mentioned, that bottle of wine you enjoy, you can still purchase 4 years from now and keep up with inflation. And then the last bucket, this is really the growth engine. As I mentioned, inflation is coming down around the world, but we've all experienced how our personal spending bucket goes up every year, and we need to keep track of that. I mean, it's staggering if you consider inflation, what things will cost 10 years from now, 20 years from now, 30 years from now. And this is really your long-term engine where you want equity-like exposure, shares, equities. I mentioned to you the type of return that one can typically achieve here. And this is really the best environment to beat inflation over the long run. It is more volatile. I'll show you, if you invest for the long run, it is the best inflation beating instrument to be in. And you need this fast horse to be able to keep track of inflation. Just a reminder, I think we've all heard the saying that time in the market is more important than timing the market. And this is just, again, some analysis behind that. So the green is a strategy where, let's say you started in 1926, you invested $100. And what you did is you tried to time the market. So let's say the market was the previous month, it was at an all-time high. You sold at that point. You waited for it to drop because you wanted to buy low again and ride it up. So you wanted to time those drops. Following that strategy, after every previous month high, you would have ended up with $9,922. If you just remained invested in the market without trying to time it and switch in and out, you would end up with $103,294. So massive difference. You can see the volatility. Naturally, on those dips, that's where it's very difficult to hold on. At that very tip, that's usually when we feel like, no, we just want to sell out. This is too painful. But it just shows you remaining invested strategy. I mean, there's various statistics, but typically the market produces the most growth in a year. I mean, you can count them on your fingers. 10 to 20 days of the whole year, you typically achieve, most of the return for the whole year. And if you're not invested on those days because you were trying to time it, you also miss out. So time in the market, not timing the market. This just talks to the same story, but just volatility. As I mentioned, your equities and shares, yes, they are more volatile over the long run, but if you give them time, the volatility drops. So if you just think about 1 year, if you just want to invest in equities for 1 year, this might be the type of volatility that you experience. So you can be up 52%, you can be down 37%, and that's scary. And that's back to the investment philosophy, where if you need money a year from now, don't invest it in shares, invest it in cash. Short-term volatility is too much. If you look out 5 years, you'll see a much different picture. You can be up 29, but only down -2. 10 years, up 20, -1. And then if you invest for the long run, you can see that there's no negative return even. So up 18, minimum was 6. And that's the message here, is that your short-term cash flow needs, invest them conservatively. If you invested in equity, be in it for the long run, stay invested, don't try to time the market. It will reward you over time, over and over again. Okay. And then turning to the last point, just something on estate planning and structures. We've invested, we've lived off our capital, we've thought about legacy and philanthropy. Estate planning is important throughout the process, but especially if there's going to be significant assets that could potentially be left, for a next generation. I think just important again on this point is that it differs quite significantly from country to country, tax laws and regulations. So just check these with your local laws as well. But I just want to touch on some of them. Trusts, global trust. What's the goal of a trust? It is really to preserve capital for the next generation. The benefit of a trust is that it's completely separate from your personal estate, which means if you pass on, the trust will not cease to exist. It is a separate entity from you. So it's not part of the long estate process. There's no estate duty involved because it's not part of your personal assets. And naturally, there's quite a big saving on estate duty. And as I say, the assets are not caught up in an estate process. It's available for the beneficiaries because it's a separate entity from yourself. Trusts are often structured as the shareholder of business entities. So you might have your PTY limiteds or your CCs or your business entities with the trust owning those businesses. And the reason is again for continuity. Should something to happen to you as a business owner, the business will not cease to exist because the trust is the shareholder. You're not the shareholder in your entity. So it really helps with continuity. If you have someone who can run your business after your passing, the profits can still flow through to the trust and again to your beneficiaries and your loved ones as you've set it up. Citus tax, Citus inheritance tax is really charged by the US and the UK when you hold individual shares, UK and US shares in your personal capacity. You can get around that if you buy into a unit trust or a collective investment scheme, but these structures I'm talking about also helps to avoid that tax. So if you hold that share portfolio in a trust, you avoid Citus inheritance tax of 40%. It's quite significant. So you don't want to you want to obviously avoid that at all costs. Trust, more flexible assets can be placed in the trust. You know, things like properties, as I mentioned, the shareholding of your business. So trusts are quite flexible in that way. The big caveats with trusts, however, is it's costly to set up, it's costly to maintain, and you know, there's quite a bit of compliance around it, whether it's accounting or annual compliance, reporting that needs to be done. So trust can be a bit of a headache from a cost and an admin point of view. So one just needs to think really carefully if it's the right instrument, you know, for your purpose. Things like OPs, that's an offshore pension structure. How that works is, again, it's separate from your personal estate, the same as with trusts. So it's the same benefit. It's outside of your estate, save estate duty. It's easy to get capital to your loved ones. In South Africa, for example, that's why I say just check with your local tax rules. But if the capital that you put into this structure is exempt from donations tax, so you can put the capital in there, and then it's outside of your personal estate. So that's quite a handy tool to reduce your estate and to reduce the estate duty. But importantly, it's not solely a estate duty planning instrument. The intention must be, you know, for retirement purposes. The tax authorities are quite clear on that. Again, you avoid Citus tax. The big difference with the OPs is you can't just draw money out of it, like with a trust. You can only take benefits from the age of 55. So you can see the intention behind this. It's a retirement type of product. You know, you put money in there, it grows, and at some stage you will draw income from it. Yes, it can be lump sums, doesn't have to be monthly. But the intention behind a structure like this is you want to preserve your wealth internationally. You don't know where you're going to stay. And at some stage, you want to start drawing an income as you perhaps slow down your business. Maybe you have to, maybe you want to. That's the type of instrument this is. If there's surplus capital left at the end of your lifetime, you can roll that into a similar structure for your family. OPS is a bit more limited than a trust in terms of which assets you can hold there. So it's mostly built for financial assets. Can't really put your property or your business interest in an OPS. Again, the goal is to have a retirement instrument. That is what this is about. It is less complicated to set up and less costly than a trust. And then the last one, international endowments. Benefit here is really easy transfer of investments to your family at your passing. How it works is you nominate a beneficiary. So it works the same way as life cover. So it pays out quickly to your loved ones. Again, it's not part of the whole estate process. The important difference, however, is you will still pay estate duty in international endowments, where you don't pay estate duty with the OPs and the trust options we had. You avoid Citus tax still in this environment. It is limited to financial assets. So in the same way, you're not going to put your property or your business in an international endowment. It's made for financial assets. And really the biggest benefit of this one is it's easy to set up, low cost to set up and to maintain. So it's really the easiest and lowest cost way, you know, sort of to get into the market and to have easy transfer of investments to your family. that is my story. Thank you very much, everyone. There's my email. You're welcome to reach out to me, and then would love to hear input, questions, thoughts. Love to engage.
Thank you so much, Pierre. So who has any questions? Do we all have at least 2 years worth of cash sitting in your bank accounts? No? I see Greg is shaking his head. Anybody else? No comments about where your cash lies right now. Where's your wealth? What are you doing with it? What should you be doing with it as you move forward? And I think that becomes a really important question now as your businesses are growing. We tend to live to the level of where our cash is. So what are you doing with your cash as we go forward? And 2020, if anything, has taught us a lesson that we need to be making sure that we build in wealth for those unforeseen moments. And by the sounds of things, there's going to be an unforeseen moment coming at us at some stage. So who has any questions for Pierre? What are you doing with your money? Do you have it only in South Africa or in the country that you're in? Should you have more than one bank account around the world? Where does your money sit right now?
I
Karen.
have a completely different question.
Yes.
Pierre, what sort of effect does things like what's going on at the moment in particularly, let's look at South Africa with the Madlanga Commission and all of the uncertainty around what's happening with, the police and everything. What kind of effect does that have on our, like South Africa's stability in the market?
Yeah, it's a great question. Thanks, Karen. I think it's back to that K-shaped economy story. I mean, the irony of how these things work, and it's fortunate for investors, but it's also sad for for everyone on the ground kind of thing. Is there is a massive difference between what the markets are doing and the real economy on the ground, the real challenges. I mean, to make it practical, I mean, I think few people will believe me if I say, I mean, I showed you the US equities and gold, but the Johannesburg Stock Exchange, the South African equity market, was one of the best performing equity markets in the world, over the last year. Now I ask you, do we have any proof on the ground why that should be the case? And look, and there's obviously quite a few positives in the economy. I mean, I don't want to shoot that down. I think there is definitely green shoots, but I think to your point, Conor, I think there is a very big difference. So we have major challenges on the ground, whether it's economic or political, but the markets are completely separate from that. And the reason for that is South Africa is tiny, compared to the world, and the world just sees us as another emerging economy. And how investors think about it is, if they're uncertain about the world, they will typically invest their money in the US, in more developed countries where their return is a little bit lower. And then, when they feel a little bit more bullish about the world, they want to achieve a higher return. And they would typically then invest in developing countries, but it includes everyone. So everyone gets the love. South Africa, Brasilia, everyone. So they really focus on the BRICS then. So we've seen quite a large influx to that tune. I must also add the fact that we've been removed from the grey list. I mean, that was quite positive. So we've seen that benefit. And the other large benefit we're getting at the moment, and that's why the rand is also quite strong, is just because the gold price has surged. I mean, we're a gold exporting nation, so our exports has really gone through the roof and is really supporting the rand. So I think a very, very important question that you're asking, for business owners and for individuals on the ground, there's almost two economies. They experience certain challenges, with political challenges, regulatory challenges. And that's often where, I mean, as I mentioned, for entrepreneurs, it makes sense to invest in your business, but there's definitely a place to diversify. Because we're experiencing these challenges on the ground where, if you've been invested in the markets, you saw that, that one graph, people that have been investing, they're feeling happy. The markets are both going up, the investments are doing well, they're feeling wealthier. So it does make sense to diversify away from just having one business in one industry, in one country in the world, and just to also have some financial assets that's growing globally. It's away from our, political challenges, and just almost grow those assets, simultaneously. If that answers the question.
Hmm.
So,
Yeah,
Pierre,
it's just sorry, Di.
Mhm.
It just amazed me that, like you say, on the ground, it appears to be so volatile and uncertain with what's going on, and yet the rand is just doing so well. Or, I mean, I suppose it's the dollar that's doing badly, but even against other currencies, the rand has improved so much. But if
Yeah.
it's gold, I know gold loves war. I've always said gold loves war. Whenever there's war, gold seems to go up in value. So that kind of explains that. But thank you.
Here, one question that I think that everybody on the call is dying to ask, but isn't. Should we only have one bank account, like in our country? Because all of us, or a lot of the people on the call are speakers or they do a lot of travel. So should everybody have their main bank account within inside their country and then another one to accept, say, euros or dollars or whatever? Or should we be bringing it all into one space? Is there big tax implications or not good or greater tax implications in other spaces?
Yeah.
What is your opinion
Thanks.
on that?
Yeah, so I think firstly, I'm not a tax expert, so can't definitely speak to that or the local, your local jurisdiction. Um, I think in general, I mean, the way South Africa work is you are taxed on your global income, whether you park it in different accounts or not. So that should, from our perspective at least, it shouldn't make a big difference. I think for me, there's probably two other benefits that I can think of. The first one would be from a currency, just the currency management point of view. I mean, to make it practical, I mean, again, I'm based in South Africa now, so to give you an example, a client of mine, he only wanted to invest offshore in dollars over the years. He didn't want anything in South Africa. And then you get periods like these where the rand is strong or the dollar is weak, and now it's difficult. If everything is offshore and you want to bring it back to live off, so that's important. They need cash flow to live off. Then you bring it back, at a strong rand, so you're bringing back less rand. So it kind of hurts. So I think having them in different currencies gives you options. I think that's important. Maybe have a local one in your local currency and one in an offshore currency where you can play that currency, depending on when you need the cash flow. And just from a risk point of view as well. I mean, I don't want to be a what's the word? But we've seen many circumstances where in tough times banks freeze accounts, and you might not have access to your capital. So again, I think from a diversification, don't have 10. I mean, they'll complicate life and push up your costs. But I think from a diversification point of view and accessibility point of view, and almost to see yourself as a global citizen, I think it makes sense to definitely have more than one in more than one jurisdiction as well, because you just give yourself, protect yourself against that risk. Because we do see it. You do see from time to time, especially in stressful times, banks can freeze accounts. And banks can also get hacked. We see that as well. They're not foolproof. So it always makes sense to to spread the risk again. And I think back to what we said, don't leave everything in the bank. I mean, buy some unit trusts, collective investments, shares, but don't leave everything in your bank account, because that's also a single point of failure risk that one's creating there.
Awesome. Thank you. One thing that was interesting for me that Japan didn't feature anywhere, and they were such a strong country at one point. Clearly, they losing market share as China takes over, or what's happened with Japan?
Yeah, it's a great question. And again, not chief economist, but my 2 cents, it would be, I think Japan's big problem was their aging population. So massive aging population. So their productivity, drop significantly. You have more and more people that's retired that needs to be supported, by pension funds while you don't have productivity in your country. I mean, the less productivity, then there's less taxes, floating around. So Japan, And then what we're seeing at the moment is we're seeing massive yield spikes in their bonds. And what that basically means is the world is saying, sure, you guys are risky. If you want us to invest in your bonds, you must pay us, much more to do that. So they're really battling. They were battling to get inflation going. Now they're battling with this high yield story. So yeah, it's very true, Diane. I mean, they're a very respected nation, but they have structural challenges that's going to take quite a long time to overcome.
Yeah. Interesting that Europe is doing so well because Europe is also supposed to be an aging population, but that's fascinating. Valerie, you got a question? Can't hear you.
You can't hear me?
Okay, now you're back on. Yeah, we didn't for a sec.
Okay. For the bank account, I really like Revolut. I don't know if you know it, but I think it's from Lithuania. I can send the link in the chat. That account is amazing because when I went to South Africa, I could exchange money with like no fees, and then I could pay with my phone. And I think like getting a plastic card is like $10 or so. It's amazing. You can store money in all different kind of currencies. Just if you're curious, I really like that account because I have multiple. And I have a question because you said that the US is devaluing, like that the US dollar is devaluing, but that also means that all of my shares and my funds, everything that I have invested is also devaluing if I have anything in the US. Like, how can I prevent this from happening? Because I cannot not invest in US shares. That's like not possible.
Yeah, that's a very, very good question. So there's really two separate sources here. The one is, as you mentioned, it's the actual investment that drives the underlying growth, and that is, for example, you want to buy Nvidia shares or Apple or Amazon or Google. You want to be a shareholder in that company because you're seeing great growth, earnings growth, and you want the underlying growth engine from there. So that's step number one, and that's still very strong US based. Yes. The globe is catching up a little bit. It's not only just the US tech story anymore, but it's still a very strong theme going forward. So you want exposure to that. What you can then do is you can buy a unit trust fund which invests in that, but they hedge to another currency. Whether that's euro or pounds or South African rand, where I'm sitting. So that's a way in where you can get the underlying dollar growth, but you can hedge the currency, to something, that's more in your favor. As I mentioned, the dollar, it's not a 1 year or a 2 year story, but if it's a long-term trend you want to think about and you want to buffer yourself against that will be a great way to do that. So again, there's multiple of these, unit trusts around the world. So just look for one that underlying, they invest in, the companies you want to invest in, but they hedge the currency to something. I'm not sure where you are based, but they hedge it, to a euro or a pound or whatever, currency of your choice. So that is definitely possible. So then you get the underlying growth, but you're also taking a view on the currency movement, and which one will be in your favor going long term.
Awesome. Thank you so much for that. Right, we're coming to the end of our hour. Hope you enjoyed it. It's probably a topic that we don't listen to enough. We don't understand enough, but we make choices of what our future is going to be like. So that's quite an interesting one always. Please reach out to Pierre. Please don't spam him, but reach out to Pierre if you've got any other questions going forward. And we look forward to seeing you next week. Thank you so much, Pierre and Rebecca, for joining us today. And thank you, everybody, for being here. Good luck with the start of the Firehorse season that started today. I hope you're all wearing other color, not black and white, because that doesn't bring in the good feeling for the year. So enjoy it. Have fun. Goodbye, everybody. See you next week.
Thanks, everyone. Bye.